All right, everyone. Well, welcome to today's Trading Pub's half-day trading class. We appreciate you guys being here. Looks like we've got a great crowd in the room, just over 1,100 people. So again, very excited to have you guys here today. Give us just 1 second. I'm trying to get the schedule uploaded for you. But real quick, before we get started, if you can, type in where you're joining us from. So again, everybody type in where you're joining us from today. All right, good deal. Well, yeah, kind of hard to read with everybody typing that in. Let's see. Got Maryland, Mexico, Australia, Switzerland, Singapore, Kansas, Iowa, Chicago, Tulsa, Oklahoma, Concord. All right, good deal, good deal. Poland. Well, here's a quick look. It's always fun to take a look at the map. But let's see. Give me 1 second here. We're going to put a quick look at the map up there. So you see we've got the world pretty much covered. Looks like we've got just about every continent. So again, yeah, you can see if you expand it, you can click on the little dot and see where everybody is. But I really appreciate everyone being here. You know, you guys are wonderful. We love our Saturday classes, and we're going to do the absolute best that we can to make sure that it's a good experience for you. So a couple things real quick before we get started. We'll give you a second to read through a risk disclaimer. In case you didn't realize this, there is risk involved in trading. So again, you know, not everybody makes money, not every strategy makes money, but again, you're really here to learn, and so we appreciate the speakers that are here to be here with us, taking time out of their day. I did put a copy of the schedule. If you click that link that I just posted that says March 2 schedule, if you click that, you can see the schedule for today. We are recording today's event. So again, we are recording today's event. Basically, what we're going to do is we'll record each session. We break it down session by session and then post it on our website. For those of you that haven't been to our website before, it's tradingpub.com. And basically, you just go to tradingpub.com, click free education at the top, and that'll take you through it. So again, we'll email that out to you. We'll also post it on our Facebook page. So again, we appreciate you guys being here with us today. I'm going to take a quick minute, tell you a little bit about Trading Pub, then I'm going to turn things over to our first speaker. The mission of Trading Pub is to provide a place for our patrons where they can hang out with some of the top traders in the industry. Pub is the place to receive quality education, all while interacting with traders and investors who are just like you. So again, we appreciate you guys being here. I'm going to type something into John Coffey real quick. Three things about the Trading Pub. Obviously, we're a free educational website. We want you guys to learn about the market. We work with top traders throughout the industry. We want you to enjoy your time here. If you've been to a Trading Pub event before, you know things are pretty laid back. It's all about education. You know, we want you guys to learn, and basically, you know, nobody wants to come and sit through a sales pitch or sales presentation. So basically, what we do with the speakers that come on, we say we want to give you really good education, and then at the end, give them some kind of free trial or small intro offer just to get started. So thank you very much, Jose. Appreciate those kind words. And then also what we try to do with Trading Pub, with any revenue that's generated from the website, 10% of that is given off the top to charities. We do a lot with inner city revitalization and workforce development. If you want to stay up to date with us, again, we'll post our recording on the website, which is tradingpub.com. For those of you that are in the Twitter sphere, it's twitter.com/tradingpub. And then for those of you that are on Facebook, we post a lot of our content, recordings, videos on Facebook as well that you can check out. All right, a couple of rules of the road before we get started. I'm going to turn things over to Dr. Frank as our first speaker. The rules of the road, if you're going to be here, you know, obviously, you know, our site's free, this event's free, but all we really ask of you is that you be considerate, not just to the speaker, but to the other people in the room as well. So if you're going to be here, don't be that guy on the left. You know, if you're going to be here, be cool. You know, respect the people that are talking, their time. I know that they're respecting your time. And again, we appreciate you guys being here. So Frank, at this time, I'm going to turn things over to you. I'll put a timer up. You'll have 50 minutes. So the next 50 minutes, the room is yours. So everybody should be able to see.
Thank you, Morgan. Let's just do another mic check just to be sure. I'm impressed that we have excellent sound in India. That kind of blows my mind. Because sometimes here in Florida, we don't always have excellent sound, so I think that's pretty funny. Anyway, thank you for having me, Morgan, and I do love coming to the Trading Pub whenever I have time, sharing with people. I've known Morgan for a number of years. He's an excellent young man, young because I'm a lot older, and does a really neat thing with this Trading Pub. And one of the main reasons I come here is honestly to help out his dad's company and to help out people learn about options. And also, I know people I've talked to about the Trading Pub, and I really like to help these interested people. So I don't generate any revenue from these presentations here, but I do it, and it's kind of my charitable contribution in addition to other things. Let me raise the volume a bit. I've got a big mouth, so we'll see. I'll lit it just a wee bit. I don't want it too loud because I don't want to blow people away here. Ask my kids. They'll say I blow out eardrums. Let's see. All right. How is that, folks? Is that a little better? Because I don't want to blow it too much because I can't. Louder. Should I just talk louder? Is that better? I can talk louder too. I can raise up, crank it up. Okay. I'll talk a little louder. It's early in the morning on Saturday, so I have to kind of get charged up here. I had my cup of coffee and such. Sometimes actually I'll run to Starbucks. Didn't have time today and grab the Starbucks. Anyway, today what we're going to do, and this is a neat thing when we come to Traders Pub, because at Traders Pub, and there's a slight lag with my slides, so give me a second as I forward. We're projecting them from my location. One of the things that I like about the Traders Pub is that as we're all presenting, things kind of dovetail. Like you're going to see presentations on candlesticks and so on and so forth, and everything you learn can kind of go hand in hand. One of the nice things about options is almost everything you learn here, options can be applied to. And there's a variety of different things that Morgan has people show here. So the really nice thing is that, oh yes, and also you do have a volume control. I probably should make that point. Thank you. In the lower left-hand corner, you can raise that volume. So always try to do something a little different every time I come. And we do have videos of my past presentations to kind of help you out. Basically, I want to talk about spreads as a way to generate income, and there's both long and short spreads, and we'll get into those. And really, I am an educator. I'm a trader, an educator, and that's really what I try to do. And so I don't make trade recommendations, but I'm more than willing to share my trades with people. I do that on a regular basis. And again, I do it to educate because you can see slides. Seeing live things, or live as you can get it, is valuable to people. As far as risk goes, there's three things I always like to teach. Everything I do is teaching. And so when I talk about risk, and you can read this as I speak along, but basically you deal with risk by getting well educated, by learning good risk management, and by managing your emotions. And the analogy I've always liked with trading is that of pilots, even though I'm not a pilot. You know, they get educated to flying, they do the flight simulators, they know what to do when an emergency comes, and they stay cool. They maintain their cool. And that is the best way to deal with risk. And so education, learning and applying good risk management, and then managing your emotions. And I am a clinical psychologist and a professional trader. I've won a number of awards, actually in psychology as well. You just see the trading awards here. I love doing this stuff. I love teaching. In fact, sometimes my friends say, "Why do you do this stuff?" And bottom line is that I've always liked to teach people and to play it forward. We're not here forever, and so if we can, with my kids, with family, with other clinicians in my practice, I love to do that. And I also have a little love that I like to talk about just briefly, and it's this human performance, and not just for traders, for other human performance. And I've really gotten deeply into brain waves and brainwave generation and things called Nexalin technology and transcranial stimulation and neurofeedback. And I've done biofeedback for years. I'll tell you, if you've never taken advantage of some of those techniques, there's probably people all over the United States that at least could do peripheral biofeedback. Neurofeedback, there's a smaller group of us that are boarded in that, actually board certified. You can go to AAPB and also bcia.org bcia.org if you want to find certified practitioners who are board certified. And I would encourage you to do that. So I'm not here to promote them today, but I do want to encourage you. It's a part of technology that you really should take advantage of. So today I'm going to talk about debit spreads and credit spreads. As I said, one of the things I like about this is you can apply this to every single thing you see today and other days in the trading pub. And I'm not here to give you a basic education on options. I'm here to show you some techniques that reliably can result in return. Okay, so you can reliably have a result in return. I don't know where the beeps are coming from. I have no beeps here, so I'll let Morgan handle that. Yes, you can day trade as well, Gillian, and I'll chat a little bit about that as we go along. I actually did a day trade on Priceline. You can actually sell volatility, and I'll talk a little bit about that as we go along. But the two main spreads that I like to use and I suggest are debit spreads and credit spreads. And I actually have a presentation. I told Morgan I'd be glad to do this in the future that I've done before, and it's comparing debit and credit spreads and really comparing one with the other and really drilling down in them. And I really need to write an article for Futures Mag on this too. I just haven't had time, but I've got some good information on that. So today I'm not going to go in a lot of detail this. I'm just going to generally show you these concepts, show you some examples, and hopefully teach you a little bit about this. If you're new to options, this is a great way to start learning about options and learning about what's available. Now, for those of you who are newer to trading and to options, because I also am a psychologist and I've mentored people, I like to have you have a plan of action. So I always like to start with that. And what I recommend is people select one strategy to master. And this can apply for anything, for futures, for currencies. And so, yeah, and Gary is right. You do need 25,000 to day trade, but you can day trade in the USA. But if you have less than 25,000, you can only trade 5 times. It's basically 3 round trips, which, by the way, with options, that's a lot of money. So in a 5-day period, you can only do 3 round trips. I don't do a massive amount of day trading. I do it through earnings. Most of my stuff is generating income on a weekly basis. So you can do fairly well with options because of the leverage you get from them. And again, I'm not going to talk about all the advantages of options. That's another presentation. And I would encourage you to go back in the list of videos that Morgan has in the Trading Pub and go back and look at some of mine. I've got everything from basics to that I've been presenting. If you look at all of them, you probably got at least half of a course for free. Okay, so you want to select one strategy to master. In this case, I suggest vertical spreads. Now, there are different spreads. There are calendars. There's covered calls. I have students who do very well with them. But in this case, I'm going to be focusing on the verticals. I believe in beginning with equity or index ETFs. And index ETF is SPY, DIA, QQQ, IWO, IWM, so on and so forth, GLD. I recommend that you start with those because they're safer. There's less risk. Actually, there isn't that much risk with future options, but you got to know futures first. So, and anything you learn here today can be applied to futures. And there's some really neat things that you can do that. In fact, I think one day I am going to do a presentation on futures options trading in the near future, no pun intended. Also, a very important thing, and this comes up again and again and again, and this is developing mastery over your trading platform. Make sure you know how to trade the platform before you trade anything. I know a lot of us get real excited. We learn techniques. We see people making money, and then we make execution errors, or we don't understand the platform. And really, you can, right, Ken, you can do options on any market. The other thing I would say is with action, with your plan of action, try to get 85% consistency in that first strategy. So if I'm doing spreads, and I'm not saying 85% consistent in profitability, I'm saying 85% consistent of using the technique. Let's start with the technique. Learn your platform and learn your technique. When you can do it, I mean, basically, and I might do this one day. It'd be kind of a fun trading pub. We have such a variety of people here that I don't want it to be too advanced, but I actually do Ask Blue Horseshoe, and that's my nickname, and I'll have people just throw up different stocks or ETFs, and I'll come up with options trades on them, almost rapid fire, by looking at the option chain. I'll give them, look at the chain, look at the chart, and give you option strategies. And it's really kind of cool. Maybe one day I'll do that. But I don't do that here that often because I need to almost have advanced, people know something about options to do that. Also, the other recommendation I have is begin with at-the-money long options or slightly in-the-money long options, and then sell out-of-the-money short options. So if you're going long, use at-the-money or slightly in-the-money. If you're going short, use out-of-the-money. And we'll see that in a few minutes. Also, create a trading plan. So if you want to trade options, please pick out a platform And I'm not going to talk about platforms here today, but pick out a platform, pick out a strategy, pick out a way to read a chart or some program that's good, I don't care whether you candlesticks, e-signal, whatever, and learn your charting and then stick with that plan and then decide what you're going to do. For a lot of people, going long the market is easier than going short the market, but you can go long and short by going long the market with options vertical spreads, and we'll talk about that. And again, keep that initial approach simple. And so I tell people, if you've never traded an option before, I actually teach people just how to sell calls and puts. Now that's pretty basic, and I have a basic presentation for that and DVD, and I'm actually creating a new class. But keep your approach simple as you can. I would probably say this is beginning to intermediate in terms of what I'm teaching here. So basically, for those who are a little bit newer, let's talk a little bit about options definitions. You have to understand what these things are, okay? So let's start from the beginning. The first thing is an option is a contract, and you need to know that. And so it's just like a business contract. So what is there with contracts? Well, typically, there's a cost to the contract. There's something that is a signal to execute the contract. And typically, there is a date of expiration for the contract. And really, options have all three of these, and we'll briefly talk about them. And all of those parameters of the contract are in what we call an option chain, and we'll talk about that, and I'll show you some examples. So here's some basic terminology. You'll see what's called a strike price. And basically what a strike price is it's the contract exercise price. In other words, it's the contract price for the underlying stock. So if it's $100, that means that if the stock is below $100, it has no real value. If it's above $100, it has a real value. So at expiration, if it's over $100, you actually have the right to exercise. Well, actually, you can exercise a contract anytime you want. But if that contract comes to expiration, and if it's in the money, it must be exercised, and that is at that strike price or above, or deeper in the money, below if it's a call, and above if it's a put. The premium is what you pay for the contract, okay? So if you, let's say, want to buy a house, the strike price for the house might be, $300,000. So they're not going to sell you the house under $300,000. And then you buy a contract to purchase that house. And the premium they charge you maybe, let's say, to buy that contract is $3,000. So we put a deposit or a premium, believe it or not, on that contract for that house. You open a contract on a house for $3,000, which let's say is 1% of a $300,000 house. And then what you do is they'll say in 2 months, in 60 days, you must exercise this contract or you will lose your premium. And that's the same thing as an option. I pay $2 to buy an option contract on IBM. It's going to expire third Friday in March, and it costs me $2. It's maybe for the $200 strike price. If this is not above $200, I can still sell the contract, but I won't make any real money off it. But the purpose of a lot of these options was really to have insurance and leverage, and that's the real reason why. So if you know anything about insurance contracts, if you know anything about contracts to purchase a house, then you really know the basic core of options contracts. And that's what you got to start thinking about. You're not trading the underlying. You're trading the basically what we call the derivative or the option. And that's what makes it a little bit more involved. But if you think about what you already know, this stuff is not as difficult. Now, there's also a little, occasionally I'm going to talk about at the money, in the money, and out of the money. And in the money just means that this option price is, if it's a put or a call, will be different, but we'll use a call as an example. If the call is a $100 strike, and now let's say IBM is at $110, then that option's in the money by $10. That means it has $10 of real value. So I could sell that to somebody for $10 plus, because there's also time value and volatility in there. If it's at the money, it means this option is a $100 strike and the underlying is $100. That's where it is at that moment. Well, it does have some value because, as I said, if you get a contract to buy a house or a contract which is an insurance policy on a house, it does have some value. You can always sell it back. And it depends on how high or low the price of the house goes up and down that someone will be willing to buy it back. The other thing is out of the money, and all this means is that your option contract is above the strike price if it's a call. And I'll just, again, keep it simple. Just to give you a basic concept here, if I was doing a basic course, I'd really drill down in this. So if the options has a strike price of $100 and it's only at $95 and it's a call, that's $5 out of the money, and it has no real intrinsic value. You still could sell it, but it doesn't have any real value. So it's the same as, let's say, a homeowner's contract. I buy a contract to buy a house. Well, if I'm not going to exercise that contract, if over the 60 days, let's say I wrote a contract, or someone wrote a contract for me to buy this house at $300,000, and the market's tanking, and now it's only worth $280,000. Well, either one of two things I can do. I can go back and bargain or negotiate with the, with the person who owns the house, or I can just say I'm going to forfeit the $3,000 because I'm not going to pay him $20,000 more than I have to. And basically that would mean now that my contract went out of the money on that house. Very, very simply. So if you think about contracts, there's a relationship. Now, I'll talk about this a little bit more as we go into the option chain. Now, where do you get all the information about the contract? Well, if this was actually an insurance policy or a homeowner's contract to purchase, obviously a contract to purchase a house, well, in that case, you would look at the actual written contract, and it would tell you all the specifics. Well, because there's so many parts of a contract, what we do as options traders is we have what we call an option chain. And a chain is just a list of all the strike prices and then all of the premiums that you pay and all the different variables that go into the theoretical pricing of an option. So let's just look at an example of that, and it has everything you need to know as an option trader about that contract. Not necessarily everything you need to know to trade, but everything you need to know as an options contract. So for example here, we'll use an example of Apple. Here's Apple, and again you can see that here's the actual symbol, here's the strike price, okay? And then it's telling us on the NASDAQ, and I really don't worry about that. I want to know what the actual price is. I'm sorry, not strike price, underlying price. So here's your underlying price. It tells us down 440 for the day. And then, so that's just giving you about the underlying. This is what's going on with the underlying. Okay, then here's the actual contract exercise prices, or the strike prices. And you can see that they go up and down this line. I do not give out these slides in the trading pub. I do give them out when I'm presenting privately. So if you're interested, you can email me at drstan1970@yahoo.com, and we can see about getting them to you, but I don't distribute them here because some of these come right out of the class, the different versions of the class. So this is the March, so it means the expiration is March 13th, and in this case it's 16 days away. Now it may be 14 days away because I probably did this on Wednesday or Thursday night. So here's the actual, what we call the strike price, the contract exercise price. Here's the bid and the ask, and a lot of you know about bid and ask. Here's your last price, so this is what it's trading at. So for example, if we're looking at the 440 option contract, well, to buy that's going to cost me $13.50. And we'll talk about a little bit about other parts of this, and here's what we call the delta, and that's important. And the delta we'll talk about, and then the open interest, and here's the volume. And I'll show you another slide of these as we get to some examples. But just to show you what that option chain looks like and has all the information. So the strike price, as I said, it means at that price an option buyer can buy the underlying stock, commodity, or future. And again, this can apply to many different instruments, to stocks, to commodities, to futures. And all brokers do provide the option chain information. Sometimes you may not know where to get it. Call the broker. They should have it. If they trade options, they should have it. If they don't, then I don't know why they're letting you buy and sell options in the first place. Most do, I would tell you. Okay, so if you're a call option buyer, if I bought this option, I have an option to buy a stock, commodity, or future at a certain price by a certain date. And if I buy a put, then I have an option to sell the underlying stock, commodity, future at a certain price, which is the strike price, and a certain date. We'll talk about expiration dates in a minute. Now, the thing I pay for this is what we call a premium. So we saw something like $13.50 for the Apple 440s. Well, what does this basically mean? What this basically means is that at that 440 price, I will pay $13.50. Now, this would be like my deposit I'm paying for the contract to buy the house. All right. So in that case, I said it would be $3,000. In this case, it's $13,050. Now, I did put in here that this premium, what you pay, has both intrinsic and extrinsic value. And I won't go into real detail with this, but basically intrinsic value equals how much it's in the money. So again, if the option's a $100 strike and the stock is at $105 and it's a call, that means it has an intrinsic value of $5. Now, notice Apple. That Apple option I showed you, which was the 440 strike, and Apple was at 444, that was in the money by $4.40. Now, that's interesting because you're paying $13.40 for the whole option. That means that $9 of that value is its extrinsic value. That means if we were to hit expiration and I didn't sell that contract back or exercise it, what's going to happen is I lose $9. And that's the extrinsic value. Now, what is the extrinsic value? It's time decay, or what we call theta, and it's implied volatility, or vega. So, and again, the higher the beta of the stock, the more volatile the stock, the higher that intrinsic value. And we'll talk a little bit about that more as we go along. One good thing about option spreads, and this is why I like to teach spreads, is it minimizes the risk. It minimizes those extrinsic values. So we're going to look at two different strikes. And because of that, volatility risk is reduced and the cost is reduced and the extrinsic value is reduced. And so if you just bought long a call, it's going to cost you a little more than if you did a call debit spread. But let's go through a few more of the parameters. Volume. Volume's very important. This is market breadth. Now, most of you who trade know what volume is. There's a certain number of shares of a stock that trades every day, and during the day, you look at it and you see how much volume's going. The more volume, the more interest, the more liquid the stock. All right? Now, when we're talking about options, you're not looking at shares of stock. You're looking at those contracts, okay? And the contracts are traded at different strike prices with different volumes. Now, the good part about the volume is when you look at it, and yes, there's extremely high leverage on those options, correct. In fact, that's one of the values. Two of the values of options, by the way, I'm not going into the advantages and disadvantages in this presentation, but one is leverage. You get a lot of leverage. And the other thing is, and not just leverage within that individual trade, but it lets you spread your money out to have a more diversified portfolio of trades. So that's a really, really a big value of it. Another value of options is the insurance policy value. You can use options as a speculator, or you can use options as a hedge against other trades. So here I'm talking more as the speculator and as an income generator, but there's also a way, and I've presented this before from time to time, where I can show you to use strategies that are portfolio strategies that help you maintain a portfolio. And volume is good because if you look at the volume, and in fact, if you look at that option chain we just had, I'll pull it back in a minute, you can see there's volume here. And it shows you where most of the activity for that particular option is at that particular day. So we can see that there's a lot of activity on the 450 options in Apple calls. And you see that $10,251. So you can actually see that there's a lot of volume there. When you look at the puts, it looks like most of our volume is probably between 445 and 450. So that's where most of the traders are interested in trading this option at this date. So that is kind of the underlying price that they show an interest as. And you move away from that price, you can see how the interest of the volume drops. Okay, the volume drops. And then we'll talk about open interest in a minute. Okay, so just to show you where that is. And so if I'm trading that, I know where basically these guys are interested right about at the money, right about at that 440 to 445 price. And there's also some covered calls there. I won't get into that. But you can actually look at the volume and look at this open interest that we're going to talk about and actually kind of somewhat, estimate what traders are doing with that particular instrument. And actually the pattern you just saw with there was probably actually collars. You actually saw covered calls, collars, and calendar spreads, and collars on calendar spreads. I can read those option chains. And in fact, in some of my advanced presentation, I actually teach you how to read that option chain in a very advanced level. And that's not really where we are today. But I believe everybody who looks at options must understand volume, must understand the premium, the strike, and open interest. These are just essential to understand. Buying and selling, no way. That's the only thing you cannot tell, that it's buying and selling with exactness. However, there is some way that you can look at the patterns and get an idea of what they're doing. So there's no simple way to do that unless you're a broker dealer. but there are some ways. And the open interest, and I'll miss a few. I'm going to try to hop back and forth to the questions. They're coming fairly quickly, and I don't have anyone helping me here to try to answer them. So slow them down a little bit if you want me to answer them, because I only have 15 minutes. And I love your interest in this, and I'm going to give you another opportunity to learn more from me. So don't worry about it. If I don't get to the answer, I'll get to that question. And always feel free at the end to pop questions in if I don't get to them. And so one is, let's see, there was one more here. If you say the biggest open interest is at the money, why do you see such volume outside of this area? Very good question, Rosemarie, and I'm going to tell you right now in a moment. And it has to do with open interest and volume. So open interest basically is the number of contracts that are open for that day. So open interest and volume are going to vary. You're going to see volume be different from open interest. What volume is just the number of contracts that changed hands for the day. Open interest is the number of contracts that are remaining at the end of the day. Now, an analogy I like to use is we can talk about a stock like IBM and say, okay, there may be 100 million shares of IBM out there. That's the total number of shares that are available to trade in IBM per day. However, you may only have a volume of 2 million. That means that there's only enough people out there who want to buy and sell IBM stock at 2 million. There's only 2 million shares that are being traded that day. But there may be, 200 million shares available. Well, what volume is the number of option contracts that are traded during that day. Open interest is the number that are available. Now, the difference between stocks and options is in stocks there is a limited number of the stocks that are available, of the shares that are available. With open interest, it can vary. In order to increase the number of shares available of a stock overall, you must have a stock split. You probably have to have a board meeting. You have to have a vote of the investors. Many things that you have to do to have that done. With options, you and I can change the open interest on a daily basis. If I sell to open a contract or buy to open a contract, I've increased the open interest. And that's why you see these differences. You might see a lot more volume than you see open interest. Well, that's because those things exchange hands during the day, but the open interest is less because that's all that's left at the end of the day. And it varies from day to day. Also, when you look at that option chain, for example, you will see that the open interest changes at the end of each day. So the real value of open interest is looking at the end of the day and see how many contracts are open at the end of the day. The volume changes all day long. Now, the open interest does change too, but most platforms only give you the end of day. And that's fine because we use open interest as a way of determining the longer term interest. So volume tells me shorter term interest, okay? Volume tells me what strikes are people interested at, and even what particular options are interested at if you're looking across stocks. Some stocks have a lot of volume and a lot of open interest. Other ones have very little open interest and very little volume. That means there aren't that many people interested in those contracts or even in that underlying stock. So if you look at a stock like Microsoft, you're going to see a massive number of options contracts traded and a massive number, could be 100,000 open interest. You go to a stock like a Guron or a DGIT, and you may only see an open interest of maybe 1,000, and at some strikes, 0 traded of actual contracts traded. And so think about volume as your short-term indicator of where everybody's interested in that particular instrument, and then open interest is your long-term. Another thing is expiration date. Thank you, Morgan. I appreciate that. Morgan and I have worked together, by the way. Morgan and I, when we first put this together, he was in the room with me and he helped me with the presentations. And I must commend Morgan. He is the best assistant and helper that I've ever had in a room when I'm presenting. And I give him very credit, and I think Traders Pub is wonderful for him to do that because he's so good at helping people. He's a great facilitator. And so I've always missed Morgan when I'm teaching for DTI and he's not there. No one was as good as Morgan. Not to put anybody down, but Adam's a good guy too, but Morgan the guy gets the gold star. Anyway, so expiration date. On the expiration date, like I said, all contracts have a day at which they must be exercised or they become worthless. So for example, if you buy this contract on this house and you don't let's say I buy this contract, $3,000 for $300,000 house. If I don't exercise that contract, if I don't close on that house by expiration, I'm either going to have to exercise another contract and talk to that homeowner, and sometimes they're willing to work with me, or I lose my $3,000. Well, it's the same with an option. You are not buying the stock. You are buying a contract. And this is why expiration date becomes so important. Now, expiration date is a value to the seller and a disadvantage to the buyer. So when we look at debit spreads, you're basically selling that risk. You're basically buying that risk in debit spreads. With credit spreads, you're selling that risk. I tend to be somewhat of a bigger credit spread trader because I am selling the risk to somebody else. And I like to sell risk, especially if risk is high. Okay, so expiration date is when your contract expires. Now this varies for options, and I won't go into all the details of that. You can get a lot of the specifics from your broker, from the option train, or from the CBOE. But basically now we have weekly, we have quarterly, and we have monthly options. Okay, and they vary depending on whether you're trading, if you're trading bond options or futures options. And I won't drill down into that, but I want to emphasize that, remember I said if you're fairly new to this, you should be really looking at trading options on equities. And actually, I'll add in there monthly options. Those are the ones to wet your feet with. Weekly options, you need to know how to short options, and you need to really understand time decay. And you really need to take a course if you're doing weekly options. Weekly options are great. They're wonderful for day trading, but you can lose your hiney if you don't know what you're doing. So I tend to encourage new people, even intermediate people, to use monthly options. I use all of them, but just to let you know that. And again, always know when your expiration date is. Always know that expiration date. Okay. Here's options expiration calendar, and you can get this calendar, just do a Google search on it, and it tells you when these expiration dates are on different instruments. So you can get it from the CBOE or just Google it. That's going to be the simplest thing to do. I would just recommend Googling it, and you'll get it. A few other things, Delta, and we're almost done with going through the basics, and we're going to talk about the two strategies. Basically, Delta, it's a number. It goes from 0 to 1, and it tells you how much the option price or the option premium will vary based on the underlying equity. So basically, if the delta is 0.5, that means every time the stock moves $1, you make 50 cents on the option. And it can be any number between 0 and 1. Now, the delta is positive for calls and negative for puts. Well, that makes sense. You know, if you're buying a call contract, you're buying an option to buy. If you're buying a put contract, you're buying an option to sell. And the reason why they have those numbers is because it's an algebraic equation that determines these theoretical prices. And so really you don't even have to worry about the negative or positive. Don't let that throw you off. A lot of chains show that. Some chains don't. As a trader, you don't need to know that. You know that puts are a right to sell and calls are right to buy. Also, one other important thing about the delta is the delta will tell you the probability of the option expiring in the money. So in other words, if the delta is 0.5, that means there's a 5% probability that that option will expire at or in the money at expiration. So it's a 50-50 chance at 0.5. Now that doesn't mean the day you buy it, that means at expiration. By the way, if you double that delta, it'll actually tell you the probability of that being touched. So if the delta is 0.5, there's a 100% probability that that strike price is going to be touched. Now that's kind of ridiculous, but it's a given. Why is that a given? Well, because it's already touched it if it's at the money, so or slightly in the money. But it's just something to know, and it's another trick that Tom Sawzenoff and I and other people who trade options will tell you. Double that delta, and it'll tell you the probability of being touched. And it's not so much important at 0.5 delta. It becomes more important at 0.16 delta or 0.12 delta. All right, now the spread trade and net delta, the type of net delta you use, and I'm going to show this in a few moments, is depending on whether it's a debit spread or a credit spread. In general, in debit spreads, you want a larger net delta, so you subtract the delta between the two strikes. And then with a credit spread, you want a smaller net delta, all right? And I'll show you examples, and you'll see that in the examples. But just to let you know that. Now, what separates options from any other instrument? That's time. And that is that time decay that I talk about. That expiration date is very important because it determines time decay or theta. And so time separates options from any other instrument. It can be your friend or it can be your foe if you're doing long or short options. And here's just a graph of time decay, and you can see that time decay really erodes the price of your premium in the last 30 days. So if you're going long options, you want to be out, especially if you're doing a swing trade or an investment trade, you want to be out 1 to 2 months. In fact, with an investment, you probably want to be out 3 months. With a swing trade, I usually do 6 weeks to a month on a long, and I can do 6 weeks to a month on a short as well. But just always keep in mind that that premium, as the clock ticks down, that premium becomes less and less. And again, it's worse with at the money and out of the money. It has the least impact with your in the money options, because in the money options, more of the premium is that intrinsic value. Okay. Most of the option charts, if you want to study them, would be on the platforms. The platforms seem to have the best way to study if you're talking about option charts. If you're talking about the different strategies, CBOE is a good place to start if you want to look at strategies. And one other thing I want to talk about is volatility. Remember I told you that the extrinsic value is impacted by volatility? Well, basically, that will change that extrinsic value. The higher the volatility of the beta of the stock, the higher the volatility of the option, the more you're going to run into problems with the prices being higher. Now, that's not a problem if you are selling the option, but excuse me. But in general, I'm giving you rules, and I'll show you a few more rules that will keep you out of trouble with volatility. Basically, you sell high volatility and you buy low volatility. So ideally, I'm selling calls and puts or doing credit spreads in higher volatile times, and I'm doing debit spreads in lower volatile times, just in general. And how do you find that out? Well, you look at the option chain, and you can see this is called the percentage of implied volatility, and you can see how it changes. So here's all the different strikes on Apple, and then you can see how it varies across strikes. And this is actually called volatility skew. And so volatility varies. So you can pull this up on any platform and look at it. The higher the volatility, the more likely that there's a chunk of the value of that premium that is based on extrinsic value versus intrinsic value. And it varies with puts and calls. Here's the ones on the puts, and you can see that it's a different profile than you get with the calls. And again, I won't go into this because this is an intermediate to advanced concept, but I just want you to understand that you want to look at volatility. If you're going long, you don't want something that has 100% volatility. If you're going short, you don't want something that has 10% volatility. And you also never short in the money, so we would never be shorting these high volatilities. Okay, so let's talk about the two strategies because we've got about 14 minutes left. So there's two income generating strategies. One is debit spreads and one is credit spreads. So one is a vertical, well, the slide will advance, a vertical bull call debit spread. And basically what you're doing here is you're going long a call and short a call. Now, the number of months you have out on your expiration depends on whether it's a swing trade or an investment trade. Most of the time, I'm 1 to 2 months out on this, even with a swing trade, because I want some time on my side, because this is a long option spread. Remember, I said you want more time with long option spreads and hopefully less time with short option spreads. Also, you don't want to pay a whole lot for these. So if, let's say the spread, let's say you're doing a 10-point spread, so I'm buying the 100s and I'm selling the 110s. If that's the case, I don't want to pay more than 40% of that, or $4. So if you're paying too much for the spread, it means the extrinsic value is too high, or you're not placing your strikes in the right place, and you have to be careful. Also, exits, you can exit at expiration if this whole thing goes in the money and you're going to be given the differential profit of these two options. You also can exit at 40% of return or loss. Remember, time decay is an issue. So let's say I wanted to make $5, I only make $2, and it's halfway through the life of this particular trade. I can always buy a new set of options 1 month out, and I take that 50% off. Another rule of thumb is if you're down 50% on these, I don't care where the underlying is, if you're down 50%, close that trade out and either roll into the further month out, give yourself more time, or decide that you're wrong on the trade. And these are some of the parameters. I'm going to get a little bit more specific with you, and come on, here we go. So here's an example. So a picture speaks 1,000 words. And these were ones that I was looking at this last week. Priceline just had earnings last week. And so if you wanted to go long Priceline, which is a bullish trade, you basically could buy the March 695 Priceline calls and sell the March 725 calls. And if you look at what you paid and then what you sold the 725s for, basically your net cost is going to be $10.35. Okay, here's the two deltas. I subtract them and I get a net delta. My parameters, and here's the rules, you can jot them down. And remember I said if I'm going long, I like to have 0.25 delta or better, either a net delta or on a straight call. If I'm going short, then I'll have less than 0.25. So my cost here is $10.35, and notice the spread is $30. So I'm less than 40% of the spread between the buy and the sell calls. So you can see that's basically $30. And so I'm $30 between the two strikes, or 30 points, and here I'm basically $10. So I met the parameters. The other thing I'm showing here is average true range. And most of you, if you don't know average true range, you can pull it up on any chart and it'll show it. It's how far that stock could move, or that underlying can move within a short period of time. Well, that being the case, Priceline could move $35 in 1 week. So if I were to take this trade, and I know how to read a chart and I'm correct, within 1 week, I could more than hit 50% target and move on. And again, it's not always going to do that. It was a little inflated because of earnings, but Priceline really moves. So if you're correct on Priceline, you know, you're basically, in this case, we were about a month out. If this doesn't move a whole lot in 2 weeks, I'll get out. Actually, I probably would get out of this in a week if it doesn't move. But you're going to get, even the daily ATR is 14 points. So if you get 2 daily ATRs, you're going to take some money home on this trade, especially a stock as Priceline. Now, you got to be good about reading a chart, and you got to be good about talking about direction. I'll tell you that in a moment. So I'm not sure, 1 ATR, what you mean by time, 1 times the ATR. Basically, what I'm telling you is that that's 1 time the ATR. You could have 2 times the ATR or 3 times the ATR. In this case, I'm giving you 1 times the daily and 1 times the weekly ATR. And this is long options, correct. We're actually going a long strategy. This is a long strategy. So we're buying an option, we're going long an option and short an option, but the overall strategy is long because it costs us $10.35. And that's why it's a debit spread. Now, let's say we were bearish. If we're bearish, we can do a vertical put debit spread. And the beauty of this is both these trades are identical, except for in one case you're going long, and in this case you're going short. So the one nice thing about this is if you know how to use one strategy, you know how to use the other strategy. Basically, we're going long or short using a put or a call and using a spread. Very, very straightforward. So let's look at an example of this. Here's Priceline on this. Again, I'm buying a 700 call and I'm selling a 760 call with the idea that it will go down. It's costing me $12. My net delta is minus 0.26. Remember I said they were minuses. And so really 0.26, negative 0.26 is less than negative 0.25. So don't get confused. We're talking negative numbers. The larger the negative number, the lower it is. If you're doing positive numbers, you know, the higher the positive number, the higher it is. So just, I know sometimes you have to wrap your head around it. A lot of times when I tell my students, think about the absolute value. Forget about those negatives and positives. And basically what you want is, if you're going long, you want a net delta of 0.25 or better. If you're going short, 0.25 or less. And again, your ATRs are the same. And I'm just showing you how far this might go in a week and how far it might go in a day. So if you're, again, correct about direction, you have a high probability trade here. Okay, now let's talk about credit spreads, because I'm trying to make sure I finish on time, and then I want to show you a couple things and give you some time if there's any other questions. And here's a credit spread. So in this case, I'm bearish, but I'm selling calls. Now here, notice that I'm selling 2 out-of-the-money calls. With the debit spreads, I did an in-the-money and out-of-the-money. With credit spreads, I'm doing an out-of-the-money and an out-of-the-money. And it could be 1 to 3 months out, depending on how much time I want to hold within that risk. So the shorter the time, the less the risk of these credit spreads. Typically, I'm 1 month out. And if you're new, I would go 1 month out. Okay, you want an equal number of options on each leg. These are not ratios. You want to get a credit of at least 40 cents, okay, a 0.40. That could be $400 or $4,000. You want to get a half decent premium out of these. And we'll look at an example of that. Again, your net delta has to be less than, and I say the absolute value here, of 0.25. And your exits are again the same. Expiration. And by the way, if both of these sides are out of the money, you can just let this expire and keep your whole premium. Same type of thing, though, if you're halfway through this trade and it's not making money and the stock or the future is not working in your direction, just liquidate the trade. Now, here's an example of a bear call credit spread on Priceline. And I actually did one of these trades. I can't remember, it was put or a call at expiration, at earnings, the day after earnings. It was a very good trade. I had to go to an appointment, so I had to exit the trade. There was something going on. but it was a one-day trade, and it was worth, I forget what it was worth, about $1,000. So I couldn't stick with it for the whole couple hours because something happened here on my end. And one of my rules is, as a professional trader, if I have a trading plan, let's say I'm flying the plane and a storm occurs, I've got to land the plane, even though it's a winning trade. And that's a day trade, by the way. So that was a weekly option that I traded, not this one, but another one. So you can trade weekly options on this right after earnings come out and make some handsome returns on a daily basis around earnings season. Again, I'm not here to tell you to teach earnings. I've actually did that once here when I was in the Traders Pub. In fact, if you go back and look at my prior presentation, I did that, and I did a Tuesday night meeting, and I showed that. And I constantly teach you guys this, so don't feel like you're not going to learn more as you go along. But this is basically a bearish option. And here, instead of paying something, I'm bringing in a credit. So here I'm bringing in a $1.10 credit, okay? A $1.10 credit, all right? And so, again, your average true range is the same because I took all this data at the same time. I think it was Thursday of this week, Wednesday or Thursday of this week. Again, my net delta is below 0.25, so I met the rules. It's got to be less than 0.25, and I brought in a $1.10. So that means in the next, I guess, 3 weeks, it is 2.5 weeks, if the option stays above my below my 735 price, then basically I keep this whole premium. A lot of times, if I take in about 80 or 90% of this premium, I close these out, and it's just a safety feature. And again, I can't do all that in a short period of time, but I wanted to just show you these strategies, and then to give you the other strategy. It's the vertical puts credit spread, so I can do the same thing going long. It's bullish, but I'm selling puts. All right. And again, all the parameters are the same. So the beauty of this strategy is if you know how to do a debit spread or you know how to do the credit spread, it's very easy to do either one. The harder part is knowing how to read charts. You got to know how to read the charts, and that's just a given. And again, someone's going to talk about candlesticks, and again, options are perceived as high risk reward instruments. They're really not as high a risk as you would think. They're really not real high risk. If you know what you're doing, nothing's really that risky if you know what you're doing. But there's risk in taking a shower every day. So you need to know that too. It's easy to slip in the shower. In fact, the easiest place to get injured is in the bathroom of your own home, and you're more likely to get injured in your home than you are anywhere else. Washing dishes or something. I've known more people have cut their hands with a knife in the sink than I have out hunting and fishing. It's kind of funny. Yes, and stockcharts.com is it's free, and you can get your data there. Talking about reading charts, just to show you, here's the E-mini. And going back to the price line, I am looking at price line for a potential trade, another potential trade. I'm looking, and really, this is all you're seeing here is a candlestick type of pattern. And this little white line is the 13 EMA. And basically what you're seeing is that the stock price is below the 13 EMA. Here's a little trick at reading charts. If you're below the 13 EMA on a daily chart, think short. If you're above the EMA, think long, okay? Basically, that's a simple thing. Now, this is just a quantitative chart. There's many charts that you can use. This is one of the many that I use. And basically, if it's above the 13 EMA and it's green, it tells me I can be long. So right now, and this is the E-mini, by the way, this is the March futures, I'm getting kind of mixed signals here right now. See red, green, and see the red, green. And as you know, the E-mini's been up and down over the past week. So this would tell me I got to step back and wait for this thing to settle out, or I could do some day trading. Or I could say, well, the trend is kind of sideways, so I'll do an iron condor, which are two credit spreads. There's a lot of ways I can trade this. I just wanted to show you the overall market because what I want to show you one other thing is price line. Right now what I got is, here's price line earnings, by the way. See that gap up on price line this week? That was Wednesday to Thursday. Notice that we had a nice rally into earnings, but then we pulled back to the 13 EMA. So I am going to be watching this. So Blue Horseshoe's telling you what he's looking at. I see that this could be a potential long setting up if the market holds up. That's why I showed you the market. If the the rising tide rises all boats, so you have to be careful with that. So basically, I have a red candle and I'm below the 13 EMA. So now I just sit here and be patient. If this starts to turn positive again, I'm also below this big candlestick right here that retraced. And we're going to have somebody talking, I believe, today about candlesticks. So this is an indicator to me to just stand back and not do anything. But the price line, those two trades I showed you are trades I'm looking at, and if I have to, I'll even go further and look at the Aprils. And I'm looking at the chart, and this is a mathematical analysis. It has 8 indicators in it, and it's telling me right now, get ready to go long, but watch the overall market. And we had that thing go in Congress right now with the president that's making me stand back and be patient. All right, so I know this was a lot of information. Morgan and DTI are offering a special here. There's something DTI called the Trader's Edge. It's not really my option stuff. It's just general. It tells you about reading charts and things like that. Also, they're offering one night with me this next Tuesday night. It's Tuesday night with Dr. Frank, and basically, my nickname's Blue Horseshoe. And for this is actually a $250 value. For $5, and I say, today's trading pub round of the beer is on Blue. For $5, you can get that DVD that's worth a lot, and the Tuesday night with me. So I would encourage you to go to that link. I mean, it's basically a mindless win-win for all of you. I would strongly encourage you to go there. So I joke and say tip a few with DTI and Blue Horseshoe. Basically, you're going to get about 4 hours of DTI training and about 4 or 5 of the trades I look at over the next week. I'm not making trade recommendations. It's just sharing with you what I do. I'm an educator and a trader. And you can get this for $5. And it's Tuesday night, this coming Tuesday night at 5 Central Standard Time. And we do record it, and you will be provided with a recording of this. So I know I had a brief period of time here. You can actually, you can review this again and stop it and listen and things like that. So you really have the slides here anyway with the video. Let me stop and open for questions. Morgan did broadcast that link. Again, I don't make anything off of this, but I believe in Morgan. I believe in promoting the trading pub, and that's why I'm here. And let me just look at some of your questions. I know Morgan's going to put the big hook around my neck and pull me off stage in a minute. The ratio open interest and volume, 450 and self-call put indicates something about that. Yes. You can look at open interest and volume and look at the direction. It gives you an insight. I would say that if you're just starting out, I would say options on equities. If you know a lot about options, then you could do options on future or Forex if you know a lot about options. If you don't, then I would suggest just starting with equities. Or ETFs are okay too. ETF is a little easier because you don't know what the individual stock news is going to be. And any trader will tell you this. If you want to trade and you know where the market's going, or you like we saw that E-mini thing, I could trade the SPY with some confidence on doing a spread because all I have to look at the overall market. Okay. Open interest basically tells you where most of the traders are holding their contracts open. So that's going to kind of what we call pin the market. So if most of the open interest, let's say, is at 100, then that's a high probability that those options are going to expire for that month at 100. Or maybe 95 or 105. You know that stock's going to be in that range at that time. Okay. And again, I might miss some of these. Ramesh, neither is better. It depends on the circumstances. Okay, so not one is better than the other. How would I be creating an options portfolio? Basically, I do look at beta weight, Abbott, and I also often will do calendars, covered calls, and collars, and also some of these actual vertical spreads in a portfolio. All of those I'll do. Yes, when I teach more detailed, I go to the exit strategies. It's just I'm so time limited now, I really can't. But I wanted to show you what I and Blue Horseshoe, who's my alter ego, do to trade options. And if there's a candlestick presentation here, please stay for it if you don't know.